The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome. You're watching Financial Planner, and over the next 30 minutes we're going to talk a lot more about mutual funds, understand what sector funds are all about, and whether or not you as an investor should be looking at them as an investment opportunity. To help us understand that and break that down further, we have with us a very special guest joining us in the studios. Hemant Rustagi, CEO of Wiseinvest Advisors, joins us. Thanks a ton, Hemant, for coming by today to the studios. Hemant, of course, I'm guessing a lot of people watching us are all taken aback by the 11% rally that we've seen in the month of Jan. Of course, a little nerve-wracking if you're not sitting long on the markets right now. But help me understand the essence of why one should be looking at mutual funds very quickly before we get into breaking that down into sector funds.
Well, I think one should be looking at mutual funds clearly because mutual funds do offer a lot of variety of funds. I mean, if you talk about equity funds in particular, investing directly can be a bit complicated for retail investor and for investors not used to basically stock market, because there are a lot of factors that one has to look at before investing in a stock or picking up a sector or a set of stocks. Mutual funds, what they do is basically they have professionals managing your money. You can give your money, you can select the fund that you want because the fund objectives are very, very clear. You just need to match your objective with that of the fund and then select the fund. So if you do that, I think mutual fund can be a great option for all those investors who are looking to participate in the equity market.
Hemant, a lot of times, a lot of viewers that we talk to normally on Financial Plan and Talk Money always try to catch the market or rather time the market, which I think essentially is probably the hardest thing to do because top fund managers would probably struggle to get the timing right.
Absolutely.
With mutual funds, obviously it gives you that whole aspect where you don't really time the market, but you enter and allocate money at every fall. Would that be one of the big reasons why one should be looking at a mutual fund? Because, of course, apart from complete knowledge, timing is another big difficulty that retail investors suffer.
But that's the rather unfortunate part. Most of investors actually want that they should be able to enter at the lowest level and exit whenever the market peaks out. But as you rightly said, it's very, very difficult for anyone to practice that. Even the most professional fund managers can't do that. And I think it's actually pointless trying to do that. What investors need to understand that investing in equity is a process. It's not a one-time activity. It's not an option where you invest for a short period and then forget about it. Like I said, it's a process. The equity funds allow you to build up capital over a period of time. For example, someone who's looking at investing for 10 years, 15 years, 20 years shouldn't be looking at timing the market at all, because how much difference a particular level of a market will make if you're investing for 15, 20 years. I mean, you won't even remember after some time at what level did you enter. So it's a process. What you need to do is, work out your objective goals, give them a time horizon, and accordingly you start investing. And I think what really works for equity investment especially is you have a long-term view, but that's half the truth. Right. The second half is follow a disciplined approach. Right. If you do that, you can't go wrong because you then average it out over a period of time.
Right. Hemant, of course, talking about equity funds, there's so many aspects to that, right? Of course, you've got diversified funds and a number of other sort of verticals as well. Talk about sector funds, because a lot of people, at least when you talk about equity markets, you've seen banking stocks rally and do exceptionally well. Capital goods, infrastructure, various rate-sensitive counters are doing quite well. When we talk about sector funds, what are sector funds? What is it all about?
Well, as the name suggests, sector funds are those basically that invest in a particular sector. The basic objective of sector fund is to allow investors to benefit from industry cycles. Now, because the focus is on industry cycle, the timing has to be right. Invariably, we see investors getting attracted to sector funds when the markets are doing very well. That means they get in at the peak of the valuations and they don't make money. Whereas I feel that sector fund can be a great addition to a portfolio, provided you know what to expect and what not to expect from them. The second important thing is that because they have a very narrow investment universe, because they invest only in a particular sector and industry, they do not provide you the downside protection, which you typically get from a diversified equity fund, because there the fund manager has the freedom to move his money across sectors, across market caps. Here he has limitation in terms of what he can do. So you need to be very clear as to what are you expecting from a particular sector. You need to choose your sector well. And then you need to be very aware of what are the pitfalls of investing in that. They can be a great addition if you invest them in the right manner.
Hemant, also, so would that essentially mean that sector funds are a great idea as part of a portfolio, should not own, and of course be used for diversification as opposed to being the sole exposure to the markets?
Yeah, definitely, like I said, it's a great idea to look at sector fund, but it does not suit all the investors.
Right.
I think it will suit basically only those investors.
Who does it actually? Who should be looking at a sector fund?
I think those investors, first thing, who are comfortable with equity as an asset class, which does not happen overnight. Over a period of time, you get to understand what equity can do and what it can't do. So one, you need to be very comfortable with equity as an asset class. Two, you must have an adequately diversified portfolio already existing there, which means that you have been investing over a period of time. You have built a portfolio which is of a decent size, and then only you should be looking at investing in a sector fund. The second set of people, I think, who can look at sector fund is the hardcore equity investors. I'm talking about the ones who invest directly in the stock. Now, typically what happens is, if there is someone who likes a sector, as an individual investor, you always have a limitation in terms of how many stocks can you pick. So let's say if somebody likes the pharma sector, you will pick up 2 or 3 stocks. But the fact is the pharma sector has many more companies. If you are looking for diversification within the sector, what you can do is you can allow sector fund to supplement your stock portfolio. Now what I'm trying to say is, if you have allocated, let's say 100 rupees for pharma, you buy 60 or 70 worth of stocks from the market. 40 rupees if you invest in a pharma fund. It gives you diversification within the sector. Okay, then this professional fund manager tracking the sector in much better manner than you can do as an investor. So you get diversification there, you have professional help coming in there, and you benefit from the growth of industry as a whole. Individual stocks cannot give you, the overall growth potential there. Because they can give you better return, or you can actually end up losing much more because you have a concentrated portfolio.
Right, Hemant, in that case, what should one's strategy be while investing in a sector fund? So what are the key factors or criteria an investor should keep in mind?
Well, like I said, I think it's very, very important that you have restricted exposure to sector fund. I know there are times when we get carried away by the potential of sector fund, because there are funds which are in limelight, there are flavor of the month kind of fund. We get attracted to them. One, even if you want to invest in sector fund, it has to be restricted. You must understand how much exposure. For example, there can be a thumb rule of how much one should invest in sector fund. But actually it will depend on each individual's risk-taking capacity. So you must look at your own risk appetite before you start investing in that. So have a restricted kind of exposure. Second is, we know that sector funds are risky by nature. There is another way you can minimize the risk. Rather than investing lump sum in just one sector, you can spread it over 3 or 4 sectors. At any point of time, I'm sure you can find out more than 1 or 2 sectors which have the potential. So if you spread it between 3 or 4 sectors, you get the benefit of investing in sector fund. At the same time, you diversify your portfolio. So you can do that. Third thing is, I think it's very important that one must have a close look at existing portfolio. Many a time, suppose you like banking sector. If your existing funds have very high exposure, which is likely the case, because if there are diversified funds which are doing well, the chances are they may have a very high exposure to the banking sector. So please have a look at your existing portfolio. See whether you already have a very high exposure to the sector, whether there is any need for you to have this sector fund in addition to the diversified fund you have. So if you look at those 3 or 4 factors, I think you can do that. So broadly, I would say 3 or 4 things one has to look at. How well diversified your portfolio is. If you feel that your portfolio is very well diversified, by all means you can start looking at taking some exposure to them. Second thing is, your risk appetite should be there for you to take the risk of investing in equities. You should be having the capability or the capacity to hold it for a longer period if need be, because there can be times where you need to hold it for the longer period than what you envisaged in the beginning. So there are 3 or 4 factors if you look at. I'm sure, as I said earlier, sector fund can be a great addition to the portfolio.
Right. Hemant, very quickly, in your opinion, with, of course, the rate cycle peaking out, and we've already seen the CRR cut last week, what funds are looking attractive to you? What sector funds are looking attractive to you?
Well, I would say one is the banking sector certainly is looking good. The second, I feel, FMCG and pharma. Okay. And the third, I would say IT. Okay. That is a bit of a contrarian call maybe, but I think these are 3 or 4 sectors one can certainly look at investing in sector funds.
Hemant, in banking, what would your top picks be in the banking sectoral funds?
Well, 2 funds. One is a Reliance Banking Sector Fund and UTI Banking Sector Fund.
And in FMCG and pharma?
FMCG would be, I think, SBI Magnum FMCG Fund. Somebody can look at, investors can look at, and also there is Reliance Pharma Fund.
And what about IT?
That would be ICICI Technology.
All right. Well, of course, that is more details coming about on why one should be looking at a sector fund and how it actually aids diversification, but complete knowledge is absolutely crucial in order to do that. And of course, that was Hemant's top picks coming in. He likes banking sector funds. He does seem quite optimistic on FMCG pharma and also the contrarian call on the IT sector fund. We'll slip into a break on that note, but when we come back, we'll take up all your financial planning related queries, so keep it with us.
The Financial Planner, presented by the Bombay Stock Exchange. Investment Ladder, presented by the Bombay Stock Exchange. IPF.
Hemant, we have a query from Sami Kossar, who writes to us, 27 years of age, as a school teacher. Salary is about 2 lakh rupees per annum. Of course, she does have a lot of queries, really. She invests in a couple of mutual funds. So she's got the UTI Infrastructure Advantage Fund, AIG Infrastructure and Economic Fund, HDFC Infra Fund. So lots of exposure on the infrastructure sector. R&R Fund, DSP Merrill Lynch Natural Resource and Energy Fund, SBI Gold Fund and HDFC Top 200. In terms of a liability, she's got a home loan of about 3,000 rupees per month. So that's the EMI she's paying for the next 3 years. She'd like you to help her with the current exposure that she has to mutual funds. She wants a corpus of about 20 lakh rupees after 10 years. She's got her mother and her father who are dependent on her. So broadly speaking, first to go back to the goal that she has, I think she wants 20 lakhs after 10 years for whatever reason. Now, what is it that she should be doing? Could these investments generate 20 lakhs or create, 20 lakhs 10 years later?
I think there are 2-3 factors we need to look at. What Sami has done is a good thing, is that identified what the goal is. The goal is to create a wealth corpus to the tune of 20 lakhs over a period of 10 years, which is exactly the right way. You have a very well-defined time horizon. You're looking at 10-year time horizon. What we need to understand is that when we talk about a period of 10 years, okay, definitely equity funds and equity as an asset class has a role to play. Because when you're investing for such a long term, you need to make sure that your portfolio grows actually at a higher level than what the inflation can do, because otherwise inflation will eat into your returns there. So done the right thing, looking at equity funds, okay. There has to be a process of how do we achieve this. Okay, equity investing is all about a disciplined approach. It cannot be like, as in when you have money, you put some money. You need to be very clear that you have a well-defined time horizon, you have a goal, target, how do you achieve that? One such way is because she is a salaried person, she can be investing through systematic investment plan. Now, to achieve this target, if I'm assuming a return of, let's say, around 12%, she would need to invest around 4,500 rupees per month, which would be like 54,000 rupees on an annual basis. I don't think with a salary of 2 lakh, she can invest 54. So another option for her is to even extend her time horizon. Okay. If she extended by another 5 years, if possible, then she needs to invest only 2,000 rupees. Okay. She's already investing 1,000 rupees but through SIP in SDFC Top 200 fund. She just needs to add one more, so 1,000 more in that. So if 2 options, one I said, if you're investing through SIP, extend your time horizon by 5 years, you can invest 2,000 and you can achieve your target. Second is, of course, she has to maintain that discipline of investing through the entire period. There are chance opportunities. There are sometime in the market time, place where you feel that I should not be investing because there are a lot of volatilities in the market. Don't do that. Continue with the process because you have a clear goal, as far as achieving this corpus is concerned. Now, there is a problem with the selection of fund. Most of the fund where she's invested are thematic fund. These are all infrastructure fund, natural resources fund, not an ideal kind of portfolio. These kind of funds should not be there for someone who is beginning to invest. What she needs to do is, I think she needs to exit from 3 or 4 of the funds. She can exit from a UTI Infrastructure Fund, you have HDFC Infrastructure Fund, AIG Infrastructure Fund, and Reliance Natural Resources Fund. Exit from these 4, look at adding 1 or 2 more funds, could be HDFC Equity, could be Reliance Equity Opportunity, which are broad-based and diversified by nature. Look at these kind of funds, because when you're investing for 10 to 15 years, sectoral fund, thematic fund require a different kind of monitoring because there are industry cycles. Whereas here, the fund manager has the flexibility of moving money from one sector to another sector. So go for diversified fund, continue this process for the next 10 to 15 years depending on her time horizon. I'm sure she can definitely achieve the targets she's looking for.
Very quickly, Hemant, she's got lump sum investments in all of these. So I'm assuming if she does liquidate these, should she reinvest this money into those diversified funds or just keep that money aside and then do an SIP with that?
No, I think because the money is already invested in the equity market and she is backing it up by investing on a regular basis. I don't think it makes sense to actually sell and then do STP or SIP again. Because when you're investing for 10 to 15 years, the market levels don't matter much. Because like I said earlier, you won't even remember after 6 months at what level did you invest. So she can exit from those funds, reinvest the money in these 2 or 3 funds that I just talked about,
Right.
and then do
then
SIP in
SIP.
those. So what happens is that she gets benefit of averaging in the same fund, and she can build up a good portfolio of a diversified fund.
Hemant, very quickly, she's not mentioned any sort of insurance that she has. And I'm just wondering, would that be important for her as well? Because she's also got a home loan which she pays monthly.
Yeah,
And
definitely.
she's got dependents.
For 2 reasons. The parents are dependent on her, and she has taken a loan. For these two, in fact, anyone who starts investing should always remember that the first thing you need to look at is the risk cover. So once you have done that, then you should be looking at basically investing the money. So definitely a term insurance cover for her, maybe to the tune of around 10 times of her annual salary, and also keeping into account how much home loan she has taken. Add these two, take term loan. She's quite young, so in that sense, I don't think the premium is going to be too much for her.
Right, Costa, that's the advice coming in for you. You've got to sort of revisit your portfolio, lower your exposure to thematic funds, look at more diversified funds like Hemant said, because that will give you the exposure and will actually help you create and generate wealth for the long term. 20 lakhs is what you're looking at. You might want to extend your time period for by about 5 years just to make it easier for you to sort of achieve that and make it a realistic goal. We'll take a break on that note, but when we come back, we'll take up more queries, so keep it with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. Hemant, we have a very interesting query from a very young viewer of us, actually. Karthik writes to us, he's 22 years old. He earns about 3.2 lakhs per annum, and that's, of course, likely to increase in the upcoming months. So he's a very optimistic young boy. He also asked, what is the best way to invest and save money that could offer better returns in the future? His parents are suggesting investing in real estate and to get a loan and get a home and, of course, use that going ahead. He does want to look at mutual funds. What do you advise him to do? He says he's a learner, so I'm guessing he's very new. How should he be sort of building his portfolio?
I think a couple of things he needs to do in the beginning. One is we always recommend that one should create an emergency reserve, which should be equal to maybe 5 or 6 times of your monthly expenses. First thing, he must create that. Second, if the parents are dependent, then he must go for a term insurance cover. He's quite young again. The term cover could be around 10 times of his annual income. If he does that, even if the parents are not dependent on him, I would recommend that, in future he's going to get married, he'll have children, then he'll have more responsibilities. If he buys insurance at this stage, I think the premium is going to be quite low. So I think he must definitely go for a term insurance cover. So after doing this thing, then he should be looking at what he should be doing for the investment. I agree with what his parents have recommended to him is to buy a house, especially because they don't own one as a family. I think the first priority clearly has to be invest in a house. Okay? Because other long-term goals can wait, and he still has time on his hand. He will have enough time to build up basically a corpus over a period of time. So what is required here is, I think, assess what kind of house you want, how much money will be required for that. In any case, even if he goes for a housing loan, he will have to fund the 20% of the margin money. So if, assume that the cost of the house is, let's say, 30 lakh or something, he will still need to create a corpus of 6 lakh. For that, he needs to assign a time horizon, whether he wants to do it after 3 years or 5 years. Depending on that, the money can be invested through a systematic investment plan. If the time horizon is, let's say, 3 years, then obviously not much money should go into equity because you don't have enough time. There he can look at debt-oriented hybrid funds. You have these monthly income plans. He can go for growth option of that, or he can even look at a short-term debt fund, depending on the time horizon. And if the time horizon is, let's say, 5 years or thereabout, then he can look at equity-oriented balance fund. Okay, there he can look at HDFC Prudence, which has been doing very well. In the MIP space, he can either look at HDFC MIP long-term or Reliance MIP, one of these funds. So make a choice based on, depending on how much time you have on hand to build up a corpus. And also a lot would depend on how much corpus you need to build over this period.
Very quickly, Hemant, also, how much money should he be looking at investing on monthly basis into that SIP to generate that 6 lakh rupees in about 3 to 5 years?
See, it depends, like I said, because clearly it will depend on his time horizon. Because we don't know whether it's going to be 3 years or 5 years. It's very simple to calculate once he knows the time horizon.
So once he needs to agree on that, then we can work backward. There's also another query that comes in, and this comes in from Suhas Malivar. He's 55 years old and he's employed, and he wants to invest 5,000 rupees for the next 7 years. Very specific with that 7-year number. What are the funds that he should be looking at?
Before deciding what kind of fund should be included in the portfolio, we need to really look at what is the existing portfolio mix. Since here that information is not available, we have to go by only his age, which is 55. The time horizon, I'm sure, is basically aligning with his retirement age. So for a 7-year time horizon, considering his age at present, my recommendation would be that he should be looking at an equity-oriented balanced fund. I would not recommend 100% into an equity fund because, like I said, he may not be in a position to take that much risk today. So he can either look at HDFC Prudence Fund or HDFC Balanced Fund, one of these balanced fund, equity-oriented ones, and continue this process for 7 years.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
That's the advice coming in for you, Suhas. And Karthik, Hemant, of course, advising you all to go ahead and sort of plan your finances better, Suhas. Those are the options that Hemant has also advised you on. We'll take a break on that note. Actually, that's all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.